Welcome to the market observations call for the week of February the 21st, 2023. Just a reminder, this replay is for advisor use only. Quick logistical or sort of programming note, plan going forward, shift these to a bi-weekly frequency as well, going to emphasize or lean to more audio versus visual. Again, assuming no objections there. Hope everyone enjoyed a good long weekend, kicking off a short week here. Unfortunately, with a trend that began going back to the beginning of February, and that is higher rates are weighing on both stocks and bonds. If you recall, at one point earlier this year, two-year Treasury floating with 4%, now in the 4.70 range, 70 basis points higher. That's in response to a fairly mixed bag of economic data. Initially, the narrative was economy is going really, really well. Growth is much better than expected. Last week, we got a 3% retail sales. That confirmed we have a healthy consumer. The Atlanta Fed forecasting Q1 GDP of 2.4%. Again, you can almost, with that data, throw out the hard soft landing debate. That is a no landing environment. That is a growing economy, particularly one that has a very resilient labor market. Unemployment now at multi-decade lows at 3.4%. The narrative was inflation's falling, Fed will no longer have to hike. Matter of fact, they're going to pause and then pivot later this year. Markets are off to the races. And confirmation of that, we saw the Cathie Wood's ARK collection of typically unprofitable tech companies, very, very speculative in nature. That was trading up nearly 40% at one point earlier this year. However, before we could pop the champagne, last few weeks started to see or receive some data that debates counter argument to that narrative, and really that took the form of hotter than expected inflation. We got a CPI that showed disinflation, or the rate of disinflation was falling. We got elevated PPI data. Most concerning, though, we saw services inflation come in at 7.2%. Again, services is that stickier piece of inflation, also tends to be the larger piece of inflation. So we think about getting back down to that long-term average of 2% with a services rate of 7.2. There's very few environments where that happens in a fairly short period of time. I think as one analyst put it, a majority of the disinflation or falling prices that we've received thus far has primarily been on goods, and wait for it, that has been in many ways transitory. Again, supply chains opened back up, consumer behavior shifted. People also bought all the stuff that they needed over the course of the pandemic. That was the low-hanging fruit of disinflation. A bigger challenge now, some of those stickier pieces. Later this week, we'll get PCE data. That will be all eyes focused there. That is obviously the preferred measure of the Fed, and one likely will sort of dictate their next actions where we go from here. All of this sort of coming full circle, though. A lot of the higher rates, not only in response to the data, but driven by some Fed officials mentioning they were actually in the camp of 50 basis point hike in February. Again, if you recall, Powell went with 25 and then had a very sort of nonchalant press conference afterwards, had an opportunity to really push back, say the market was missing this. That opportunity was not seized, and markets saw a downward trend from 75, 50, now 25, as sort of confirmation that pause was virtually in, which has in many ways resulted in somewhat of this surprise. Wouldn't be too caught off guard if Fed did hike 50 basis points in March. Granted, though, at this point, I think the market would be. That is likely not a scenario where risk assets would rally. Turning to the equity market, piece that we've talked about, but a lot of what has driven stocks this year, a lot of that is attributed to what has been historic short covering. So again, some of the widely shortest names likely held throughout the course of last year. A lot of those really speculative tech names, as folks are exiting those positions, taking profits there, do so by buying. Obviously, that does drive prices higher. And so a lot of the market appreciation we've seen this year, driven by those speculative names, not necessarily the rock solid, fundamental data point that I'd be looking for to get long. Granted, though, that was enough to push the S&P up to nearly 9% at one point earlier this year. Now, with early trading through 10:40 in the morning, S&P dipping below 5. So again, giving up roughly half of those gains that we've seen. Again, narrative going forward now really going to be on what is the next move from the Fed, as higher and longer likely here to stay. From a positioning standpoint, we've remained in both the tactical and the technical, or the TIM models, fairly defensive. What we mean by that is emphasizing ultra short on the bond side, as well more defensive allocation to stocks, favoring value over growth, as well as holding some elevated cash. Again, at this point, I'm probably more concerned that the Fed isn't done hiking, as opposed to being optimistic that they are. Obviously, though, as Powell mentions, we will wait and see. Ultimately, the data will dictate where we go. All else being equal, though, I'd rather be a little late versus a little early to jumping back in. From a product spotlight, there's an ETF that I follow, recently added to LPL's platform as a simplified hedged equity ETF, ticker HEQT. We'll include a quick performance graph on that. This is a strategy that emphasizes or includes a put spread collar. So going back to the series 7 days, that is long the S&P 500. They are also long near the money puts. They sell or are short out of the money calls and deep out of the money puts. So this is a strategy designed to profit by range-bound trading. Granted, you're capped on the upside, and if we did get a tail risk event, do have some exposure there. But again, if the thesis is markets will sort of ebb and flow here, remain range-bound as we get some direction, this may be something to consider for a portion of your equity allocation. This does have a loose or sort of unofficial beta of about 0.5, but again, really designed to be a strategy profiting from range-bound trading as opposed to more violent moves up or down. Also, attached to this email, there was a tool I shared with a few advisors in the group recently, something I developed in a prior life, which just helps to quantify the financial impact, not only to your clients, but also to you as a business owner by converting to a models-based practice. What we mean by that is simply moving away from each client has a customized portfolio into an investment offering or lineup that includes the use of enhanced trading or outsourcing to a third party, be it MWP, your in-house core team, etc. Fairly straightforward. I'll include a link for a video as well. A spreadsheet, you can go in, fully customize it, enter in some specifics to your respective practice. That will forecast or sort of illustrate what the impact to your revenue, to the terminal value of your practice would be based on a handful of criteria. Again, short answer there, more efficiency typically translates to better growth, more consistency, better performance, which at the end of the day, all directly benefit both your clients and your business as well. Happy to answer any questions on that. Then shifting the geopolitical front, 1-year anniversary of the Russian invasion. We did see Biden make an unannounced visit to Ukraine over the weekend. And on a positive note, Michael Jordan turned 60 last week, celebrated with a $10 million donation to the Make-A-Wish Foundation. Great organization. He's been a big supporter of that. I was actually reading an article, and interestingly enough, the last paragraph, they mentioned of all these celebrities in the world, the one that has done the most work for that organization, WWE's John Cena, participated in over 650 wishes. Great achievement there. Great organization if you are ever looking for a worthwhile charity to support. That's all for this week. As always, happy to answer any questions. If we don't connect, have a great rest of the week. Take care.